Hi everyone, welcome back to the Investors Podcast by Africa Prudential PLC. I'm Gift Isinolo and today I'm going to be your host. So we're talking about a very interesting topic today. This topic has been on the mouth of most investors. We're going to be talking about the capital gains tax. So with me is Omolayo Akindemowo from the finance team, and she's going to be doing great justice to this topic. Hi Omolayo.
Hi, Kate.
You're welcome to our podcast.
Thank you.
Are you ready to answer a few questions?
Yes, I am.
Okay, so let's jump right into it. Okay, so let's start from the basics. So in simple terms, what kind of investor activity trigger capital gains tax?
Okay, that's fine. In Nigerian law, a taxable event for capital gain tax occurs when you dispose of a chargeable asset.
Okay.
This means when an asset is sold or otherwise transferred, does a tax liability arise, not from simply holding it. An example of activities that can trigger capital gain tax includes your selling of your shares or your equity, selling of your real estate, your land and building, and selling of other capital assets that appreciate in value. Unrealized gain, simply holding an asset that has risen in value and not taxable until you sell or exit the position. For instance, you buy an AP share today for 5 naira and the value has increased to 7 naira in few days' time. Capital gain tax will not arise on that share until when you sell it off.
Wow, that's amazing. So Omolayo, let's talk numbers. When an investor sells an asset, how is capital gains tax calculated?
You determine your net capital gain. And this is basically, your net gain is your disposal proceeds minus your cost base minus your allowable costs.
Right.
Disposal proceeds is the amount you sell your shares for, and your cost base is your acquisition cost. Or for pre-2026 assets, this is the higher of the cost or market value as at 31st December 2025. And your allowable costs includes your brokerage fee, your transaction charges, and realized capital losses against gain for the year. For example, you sell your asset for 100 million and your cost base or your cost you sell it for, your cost base is 70 million and your allowable cost is 5 million. To get your net gain is 100 million minus 70 million minus 5 million. That's also known as which equals 25 million. That's also known as your chargeable gain. However, if your annual proceeds is less than or equal to 150 million and your net gain is less than or equal to 25 million, capital gain tax do not apply.
Oh, okay.
Reinvesting your proceeds into Nigerian share within a specified period can also exempt capital gain tax entirely. What rate applies? Under the Nigerian Tax Act that is effective 1st January 2026, for individuals, capital gain tax on net gain now follow the same progressive income tax that is used for personal income tax. That is 0% up to a certain band, then 15%, 18%, 21%, 23%, up to 25% on your total taxable income. In plain terms, the higher your taxable income, the higher the capital gains applied to it. For companies or corporates, capital gain tax is aligned with the company income tax rate, which is 30% for most companies.
Oh, that's really enlightening. So let's just jump right to the next question. So like most investors, they believe that everything is taxed. So can you walk us through what transactions are exempt from capital gains tax?
Okay, there are some assets that are typically outside or exempted from capital gain tax.
Okay.
An example is government securities. This includes the federal government bonds, treasury bills, state and local government bonds. And why are they exempt? They're exempt because if government does not want capital gain tax to discourage investment in public debt. And when people get it wrong, they assume that all fixed income instruments automatically exempt from capital gain tax. Corporate bond and private debt instruments are not automatically exempt from capital gain tax. Secondly, we have life assurance policy. Proceeds from life assurance policy are exempt from capital gain tax. But the common mistake people make is that they try to link this exemption to investment link or unit link products without checking the structure. The third on the list is principal private residence. However, frequent buying and selling of houses can qualify for trading, and in such instances, capital gain tax applies.
Oh, okay, that's really enlightening. So, move to the next question. So, in investing, time is of great essence. So, when does capital gains tax become payable?
Okay, capital gain tax is born at sales, accounted for at the end, and paid for at filing. Smart investors do not wait for filing season. They think about capital gain tax, immediately they exit an investment.
That was pretty quick. So the next question I have here is, where an investor ignores capital gains tax obligations, what penalties are they exposed to?
Late payment or non-payment. Once capital gain tax is due and unpaid, interest accrues, often at the commercial lending rate. Statutory penalty applies on top of it. That is how small capital gain tax issue becomes painful number. The tax itself may be manageable, but the interest accrues fast and may become unbearable. Even when the gain is later accepted as exempt, late disclosure may still attract penalties. Smart investors do not aim for zero tax at all levels. They aim for defensible compliance. Advice to investors, after all that has been discussed, is to ensure they are able to take advantage of the exemptions that comes from capital gain tax. And in the event they exit a position, they ensure that they are aware of the tax rate that applies on their gain.
So you've heard it from Omolayo Akindemowo from the finance team. She has done justice to this topic. I'm sure you must have learned one or two things. And please implement them. Don't forget to follow us on all our social media platforms. And don't forget to join us on our next topic. Bye.